Welcome back to your channel, The Big Reset Investment. Ever wondered how Warren Buffett, one of the wealthiest men in the world, makes his investment decisions? Well, today we're uncovering the 3 key principles that have led to his astounding success. Warren Buffett, a name synonymous with extraordinary wealth and investment genius. Known as the Oracle of Omaha, Buffett is one of the most successful investors in history. His journey from a paperboy to becoming the chairman and CEO of Berkshire Hathaway, a multinational conglomerate holding company, is nothing short of inspirational. But what's even more intriguing are the principles he's followed to amass such wealth. Buffett's investment strategy can be broken down into 3 simple yet profound rules. These are the principles that have guided him throughout his investment journey, helping him pick winners and avoid potential pitfalls in the market. The first rule, as Buffett puts it, is to understand that a stock is not just a ticker symbol or an electronic blip, but an ownership interest in an actual business. It's about evaluating the business first, and then dividing it by the shares outstanding. This rule emphasizes the importance of understanding the business before checking the stock price, to make wise investment decisions. The second rule is about how to react to stock fluctuations. Buffett suggests that most people react incorrectly when stocks rise or fall. The key, he says, is to ignore the feelings of panic or euphoria that market fluctuations can induce. Lastly, the third rule is the concept of the margin of safety. This principle encourages investors to only buy stocks when they are priced well below their intrinsic value, providing a safety net in case of errors in judgment or unforeseen market fluctuations. These 3 rules form the bedrock of Buffett's investing philosophy. They are simple, yet so powerful that they can potentially transform your investment strategy and lead you to financial success. So, if you're ready to unlock the secrets to wealth building, stick around as we delve deeper into each of these principles. Let's begin with Buffett's first rule. A stock is not just a ticker symbol or an investment vehicle, it's a part of a business. Now, this might seem like a simple concept, but it's incredibly significant and often overlooked by many investors. When you purchase shares of a company, you're not just buying a piece of paper or a digital entry on a screen. You're buying a piece of a living, breathing business. So how do we put this into practice? It all starts with understanding the business behind the stock. This is where the homework begins. Dive into the company's annual reports, dig deep into its financials, understand its business model, and get a grasp on its competitive position within the marketplace. Let's consider a hypothetical example. Imagine you're looking at a stock for a company called Tech Titan, a leading software provider. If you were to just look at the stock price, you might see it's been on a steady upward trajectory for the past few years. This could lead you to believe that it's a good buy, but what if you delve into the business behind the stock? You might discover that Tech Titan's revenues have been declining, or that it's losing market share to competitors. You might find out that it's heavily in debt, or that it's facing a major lawsuit that could impact its future earnings. If you only focused on the stock price, you would have missed all these crucial details. This is why it's so crucial to understand the business first. The stock price is just one piece of the puzzle. It's the result of everything that's happening within the business, not the cause. Now, once you understand the business, how do you evaluate its worth? This is where you divide the value of the business by the number of shares outstanding. This gives you the intrinsic value per share, which is a measure of what the business is truly worth. Let's go back to our Tech Titan example. If you've done your homework and determined that the business is worth $10 billion, and there are 1 billion shares outstanding, then the intrinsic value per share is $10. If the stock is currently trading at $15, it might be overvalued. But if it's trading at $5, it could be a bargain. Remember, the stock market is a marketplace. Prices fluctuate based on supply and demand, not necessarily on intrinsic value. Sometimes the market overvalues a company, and sometimes it undervalues it. Your job as an investor is to identify those opportunities where the market price is significantly different from the intrinsic value. This is not to say that you should ignore the stock price entirely. It's still an important piece of information. But it should not be the first thing you look at. It should be the final piece of the puzzle, after you've evaluated the business and determined its worth. In the words of Warren Buffett himself, "I never attempt to make money on the stock market. I buy on the assumption that they could close the market the next day and not reopen it for 5 years." This mindset underscores the importance of understanding and valuing the business first, rather than fixating on short-term price movements. Remember, when you buy a stock, you're buying a piece of a business. So, make sure you understand the business before you check the stock price. By following this rule, you'll be well on your way to making wiser, more informed investment decisions. Moving on to Buffett's second rule, how to react to stock fluctuations. Now we dive into the tumultuous world of stock fluctuations. The market is a roller coaster ride with stocks constantly rising and falling. It's an environment that can stir up a storm of emotions, leading many investors to make decisions based on fear or greed rather than rational thinking. One of the most common mistakes people make is panic selling. When the market takes a nosedive, it's easy to let fear take the wheel and sell off your stocks in a desperate bid to cut losses. But remember, the stock market is a long-term game. It's not about the ups and downs of today or tomorrow, but the overall trajectory over years or even decades. Panic selling often results in selling low and buying high, which is the exact opposite of a profitable investment strategy. On the other side of the coin, we have the bull market. When stocks are soaring, it's tempting to jump on the bandwagon and buy into the hype. But just as fear can lead to hasty decisions, so can greed. Buying a stock simply because it's going up can land you in hot water when the market inevitably corrects itself. So how does Warren Buffett approach these market swings? Well, he has a remarkably simple yet profound philosophy. He ignores them. Yes, you heard that right. Buffett doesn't let stock fluctuations dictate his investment strategy. Instead, he focuses on the intrinsic value of a company and its long-term prospects. Let's consider an analogy. Suppose you own a house. Would you sell it just because the price dropped one day, even though nothing about the house itself has changed? Probably not. You know that the house's value is not determined by daily price fluctuations, but by its intrinsic qualities and long-term potential. The same principle applies to stocks. Buffett treats each stock as a piece of a business, not a ticker symbol that goes up and down. He invests in companies he believes in, with solid fundamentals and promising futures. When the market fluctuates, it doesn't change the fact that he owns a piece of a good business. He stays the course, keeping his eye on the long-term prize, and not getting swayed by short-term market movements. This approach requires a lot of patience and discipline. It's not easy to stay calm when the market is in turmoil. It's natural to feel fear or greed. But as Buffett advises, it's crucial to ignore these feelings. Emotions have no place in investing. Decisions should be based on facts, not feelings. One way to stay rational is to have a clear investment strategy and stick to it, regardless of market conditions. Have a plan for when you'll buy and when you'll sell, and don't deviate from it based on market fluctuations. This will help you avoid impulsive decisions and stay focused on your long-term goals. In conclusion, the key to handling stock fluctuations is to stay calm, stay rational, and stay the course. Don't let fear or greed dictate your decisions. Focus on the intrinsic value of the companies you invest in, and don't get swayed by short-term market movements. So the next time the stock market takes a dip or soars high, remember to stay calm and rational. Ignore the feelings and stick to your investment strategy. Finally, let's explore Buffett's third rule, the margin of safety. Just as the name suggests, the margin of safety is a buffer, a safeguard that investors use to protect themselves from the unpredictable ups and downs of the market. It's about making sure you're prepared for the worst, even as you hope for the best. So, how does it work? Well, let's say you're about to cross a bridge. The sign says it can hold a maximum weight of 10,000 pounds. You're driving a truck that weighs 5,000 pounds. That's a margin of safety of 50%. You're not pushing the bridge to its limit. You're giving it plenty of room to accommodate uncertainties. The same principle applies to investing. In the context of investing, the margin of safety is the difference between the intrinsic value of a stock and its market price. The intrinsic value is what you, as an investor, believe the stock is really worth. This can be based on a variety of factors, including the company's assets, earnings, and future growth potential. The market price, on the other hand, is what the stock is currently selling for on the market. Buffett, following the teachings of his mentor Benjamin Graham, always tries to buy stocks for less than their intrinsic value. This is where the margin of safety comes in. If a stock's intrinsic value is significantly higher than its market price, it has a large margin of safety. This means that even if things go wrong, the stock is unlikely to fall below the price you paid for it. And if things go right, you could make a substantial profit. But how do you calculate the margin of safety? Well, it's not an exact science, and different investors may come up with different numbers, but a basic formula is to subtract the market price from the intrinsic value, divide by the intrinsic value, and multiply by 100 to get a percentage. This gives you the margin of safety. The larger the number, the safer the investment. Of course, calculating the intrinsic value of a stock is not always straightforward. It requires a deep understanding of the company and its industry, as well as a certain degree of financial acumen. But don't be discouraged. With practice and patience, you can learn to make these calculations and use them to guide your investing decisions. So why is the margin of safety so important? It's all about risk management. Investing is inherently risky. Prices fluctuate, companies fail, economies suffer downturns. The margin of safety is a tool that allows you to mitigate these risks. It's about being prepared for the worst-case scenario. And let's not forget the psychological benefits. Investing can be stressful. When prices fall, it's easy to panic and make poor decisions. But if you've bought a stock with a large margin of safety, you can rest easy knowing that you've protected yourself from significant losses. You can weather the storm and wait for prices to rise again. In conclusion, the margin of safety is a crucial concept in the world of investing. It's about more than just numbers. It's about patience, discipline, and the ability to keep a cool head in turbulent times. It's about not just hoping for the best, but planning for the worst. With the margin of safety, you're not just hoping for the best, you're planning for the worst. And that's a smart way to invest. So, there you have it. The 3 golden rules of investing from the Oracle of Omaha himself. Let's quickly recap. First, remember that a stock is not just a ticker symbol or a trade. It's a part of a business. It's essential to understand the business, evaluate it, and then look at the stock price. Second, fluctuations are a part of the stock market. How you respond to these fluctuations can make all the difference. It's important to stay calm, ignore your feelings, and not react impulsively to market ups and downs. Lastly, the margin of safety is key. It's about buying a stock for less than its calculated value. This provides a safety net in volatile market conditions. These 3 rules are the pillars of a strong investment strategy and can guide you towards long-term financial success. Thanks for watching. If you found this video helpful, please like, share, and subscribe for more valuable investment videos. Remember, investing is not just about making quick money, it's about making wise decisions. See you in the next video.